All right, let's jump right into Conagra Brands' latest earnings call from December 19th. This was a classic case of a company and the market seeing two totally different things. You had management telling this story about momentum building under the surface, while the market's reaction pretty much screamed skepticism. So here's how we're going to break this all down for you. We'll start with a quick snapshot of the Q2 numbers. Then we'll dig into management's whole noisy quarter narrative and contrast that with how the market actually read the situation. We'll look at their guidance and strategy, and then I'll wrap it all up with our take on what to watch for in their next call. Okay, so first things first, let's get grounded in the actual numbers that got everyone talking in the first place. If you just glance at the top line, you might think, it's mixed. They did manage to eke out a 1-cent beat on adjusted earnings. But wow, the rest of the story was pretty rough. A massive GAAP loss thanks to a nearly billion-dollar impairment. Sales slid down almost 7% compared to last year, and their gross margin got hit hard, down over 300 basis points. That margin compression, that's a really sore spot for investors. And this number right here, this really says it all. The market's immediate verdict was swift. The stock dropped over 2.5%, and it was on trading volume that was nearly double the average. That's a huge signal. It tells you investors were voting with their wallets, and they just weren't buying the optimistic spin management was selling. So this brings us right to the heart of the conflict. You have management arguing that all those ugly headline numbers were just temporary, just noise, and that they were hiding a much healthier business underneath. The CEO, Sean Connelly, really tried to set this tone from the very beginning of the call. He was framing the quarter not as a sign of fundamental weakness, but as a period that got slammed by a few temporary issues. The core message he was trying to send was pretty simple. Trust us, the underlying business is actually getting stronger. So what was all this noise they were talking about? Well, they pointed to four main things. First, they said retailers delayed their purchases, which they claim knocked a full percentage point off sales. Second, there was a pause in SNAP payments. Third, they decided to shift some of their big promotional events into the next quarter. And finally, they even blamed unseasonal weather for a slow start to chili season. Now, to back up that momentum story, they did highlight some real operational wins. Their supply chain service levels hit a record high of around 99%, which you have to admit is pretty crucial. They also showcased some exciting new products. Dolly Parton frozen meals and Slim Jim chicken sticks sound interesting, right? And they announced a big new multi-year efficiency plan using AI called Project Catalyst. So this is the crucial question, isn't it? If the business is strong and the problems are just temporary, why did the stock get hit so hard? Well, the simple answer is the market just wasn't convinced. And this chart really puts that investor frustration into perspective. This wasn't just about one bad day. Over the past year, Conagra stock has plunged over 33%. Meanwhile, the broader consumer staples sector was basically flat, and the S&P 500 was up over 14%. When you're underperforming that badly, it creates a very, very high bar for investors to believe your promises. At the end of the day, the market sent a really simple message. We're tired of hearing about noise and momentum. The stock isn't getting a second look until the actual numbers show a real, sustained recovery in sales, and just as important, a believable plan to get those crushed margins heading back in the right direction. All right, so let's take a look at how this quarter plays into their strategy and their guidance for the road ahead. Their strategic plan is actually pretty clear, and honestly, it makes a lot of sense. They're going to put their investment dollars into their growth engines, that's frozen and snacks, to really drive volume. For their older, more mature brands, the goal is just to manage them for maximum cash flow. And all that cash has one main destination, paying down their pretty significant debt load of about $7.6 billion. Now here's a subtle but important little detail. While they officially reaffirmed their main guidance for sales and earnings, they did make a small negative revision. They lowered what they expect to make from their Ardent Mills joint venture by about $30 million. It might seem like a small thing, but for a market that's already looking for reasons to be skeptical, it was just another little crack in the story. So let's put this all together. We've got management's story, the market's skeptical reaction, and their plan going forward. So here's our take on what you should expect from Conagra from here on out. This is really the multi-billion-dollar question for anyone who holds this stock or is even just watching it. Can they actually turn this ship around in the second half of their fiscal year? Here's our prediction. In Q3, we do expect to see sales nudge back into modest growth, mainly because those timing issues they talked about will reverse. But, and this is a big but, margins are going to stay under pressure because they're going to have to spend more on promotions to get that volume. Because of that, the stock is probably just going to be stuck in a holding pattern. The next big thing to watch for likely won't even be next quarter. It'll be in calendar 2026, when they finally promise to give us the hard financial targets for that Project Catalyst plan. So, based on everything we've seen, we're giving this a market perform rating. The valuation isn't crazy high, but the company is squarely in prove it mode. There's definitely potential for a recovery if they execute perfectly, but there are also very real risks if the consumer stays weak and those margins just don't bounce back. And of course, a final reminder, this is not financial advice.